This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
In the previous session, we went through and looked at the preparation of a cash flow forecast, didn't we? Looking at the cash inflows and looking at the cash outflows. And the result of that then led us to find out whether we had a cash surplus or whether we had a cash deficit. What we're going to go through and look at now within this session is that if we have a cash surplus, what are we going to do with that cash surplus? How are we going to deposit it? How are we going to invest it to try and generate us a little bit more cash in the short term with regard to, say, interest? And if we are short of cash, so we have a cash deficit, well, how are we going to fund that cash deficit? So let's go through, first of all, and have a look at our short-term finance. So short-term finance is whereby we have a cash deficit, or if you like, a cash shortfall. Okay. And what you've got is the syllabus goes through, I think, specifically and asks us to talk about 4 areas. First one that you've got links into your working capital that you see in the subsequent session is the management of your trade payables. Your supplier will allow you a credit period, 30 days, 45 days, or 60 days. If you are paying within your credit terms, then what you could go through and do there is you could extend the payment that you make. So instead of paying it when you previously paid it, pay it a little bit later, but still ensuring that you are within your credit terms. And what happens there is that those days that you delay paying gives you a little bit of extra cash, doesn't it, within your pocket. Okay. So therefore, you just need to be a little bit careful that you don't go over your credit terms, because if you go over your credit terms, then your supplier may charge interest on the overdue amounts, and even worse, could then begin to stop supplying you. And if your supplier stops supplying you, you've then got no goods to sell to your customers. Your customers are then unhappy, and your reputation is damaged yet further. So you really need to be careful with regards to the management of your trade payables. Provided that you stick within your terms, you're not going to create any issues, and it is essentially the cheapest form of short-term finance. It's the easiest to negotiate because there is no negotiation required. So it's the best short-term finance available, but it could only be relevant for very short periods of time. The other option that you could have is to negotiate an overdraft with your bank. So that's an agreed facility that allows you to withdraw on demand up to a particular point in time. The risk that you have, however, is that the bank has the right to recall the facility on demand. So if you're not expecting to have to pay back that overdraft and all of a sudden the bank decides to ask you for the money, you've got some problems. So I would only think there about your overdrafts. The best thing about them is that it allows you flexibility, whereby if you have uncertain cash flows, I would think about an overdraft, because yes, the bank can request repayment on demand, but the likelihood of that, you would hope, it is pretty slim. Okay, hopefully you are financially sound. You just have a small deficit that you need to plug. Your cash inflows are uncertain, so you're not sure when you're going to get the money to pay off the overdraft. So it gives you a bit more flexibility, doesn't it? You can increase the overdraft, decrease the overdraft balance that you have, depending upon the amount of cash that you need or the amount of cash that you want to pay off. Okay. Again, in terms of your overdraft, the bank's not daft. They will charge you interest upon it. That interest is tax deductible, so it is a benefit to the business in that as you pay interest, you then pay less tax. If you have more certain cash flows, so you know when the inflows are going to arise, then it may be more beneficial to take out a short-term loan. The reason being there is that your short-term loan is repayable over a fixed period. If you know when you have to pay back that loan, you want to make sure that you have the certainty of the cash inflows coming in to be able to pay off that loan. If you have uncertain cash flows, you may not then have the cash to be able to pay off the loan as and when it is required. Okay. Key bit about short-term loan is that it is a fixed amount, isn't it, that you borrow, whereby an overdraft, again, is flexible. So you can change the amounts that you are borrowing perpetually. And again, with your loan, you will be charged interest. And the same benefits there on your interest as that your interest payments are tax deductible. So as you pay interest, you will then pay less tax. Okay. The fourth and final one in terms of your short-term financing is looking at debt factoring. So that's when you have your receivable. Your receivable demands management, doesn't it? It demands you to be able to collect the cash in promptly from your customer. You might not have the ability to do that. So what you can go through and do is that you can sell that debt to a third party. That third party is referred to as the debt factor. It's a separate company. And what they will do is they will pay you cash. So you are getting the cash for your receivable from a debt factoring company. What will then happen is that your customer will now pay the debt factoring company instead of paying you. Now, what happens is I would need to instruct my customers that I have sold their debt onto somebody else, and they would then be instructed how to go through there and pay the debt factor. Sounds great, doesn't it? One issue that you have there, however, is that there is a fee. So it is quite expensive. And what makes it even more expensive is that the amount of money that is advanced to you by the factor is usually less than the value of the receivables. That takes account of the risk that the factor is subject to with regards to lack of payment, and also, if you like, incorporates an interest element with regard to the time value of money. Okay, it will take time for the factor to get the money in. They want to be compensated for that time when they are without the cash. Okay, so it's expensive because of the interest and also because of the fee that is charged. Okay, so it's great in terms of short-term finance, but it's also good in terms of managing your receivables, thinking about it from a working capital perspective. If you like, a small business that does not have the level of staff to be able to operate a functional credit control facility. If we then move it on and start thinking about your short-term cash investment, so you're looking at your cash investment when you have a cash surplus. Because if you have cash that's just floating around within the business, what's it doing? Nothing. Absolutely zero. It's not generating any interest. It's not generating any return. We want to try and get a return on it. So what you need to go through and consider when you're investing it short term is thinking about the maturity. Because when you're thinking about maturity, that's when we get the cash back. Is it easy to get the cash back when the debt matures? So we need to think there, don't we? Maybe about your liquidity. Okay, could we get the cash back earlier than the redemption date? Okay, if it's a tradable instrument, then potentially we can get that cash back at an earlier date. We also need to think about risk. Okay, we've advanced the cash, we've made the investment to somebody. If it's a bank or a credit union, then I'd have thought that there is less risk attached. But if there is money that we've advanced to an individual or we've advanced to a company, there may be a slightly increased level of risk in terms of the collectability. That risk can be reduced if we think about security, but a lot of short-term investments tend not to have security involved. It tends to be more of a long-term issue, and a lot of these investments are unsecured. But again, if you're thinking about a bank, that's a little bit less risk. There is a bit more security attached there. When you're thinking about the yield, we're thinking there about the return, aren't we? Fancy name is looking at the return. Whether that yield, that return is via interest, whether it is via some form of capital growth. Obviously, the higher the return, the better for your business. But don't forget that when you're looking at all these factors, the key bit that you consider is the level of risk versus the level of return. If you want a high level of return, you have to take on board high levels of risk, don't you? If you're only concerned about a low return, then you will get a low level of risk. And again, what tends to happen is that the longer the period of maturity, then that, if you like, introduces more and more risk, doesn't it? So therefore, you will get, if you like, more of a return the longer that you invest the funds for. Okay. Think about it from a practical perspective. You may have savings that you've put away. If you guarantee to invest those savings for 3 years as opposed to 1 year, then you tend to get higher interest rates. Okay. And that's what we're thinking about here. So what have we got? What are the ways in which we can go through and make our investments? First one that you've got there are your interest-bearing deposits. Okay. Essentially, all you go through there, you take your money and go to the bank. You receive interest on the money that you have deposited. As it is a bank, it is very low risk. You will expect to receive that cash. But as it's low risk, it is also a low level of return. Okay. With regards to the liquidity, i.e. the maturity and when you get the money back, it all depends upon the specific nature. You could have an interest-bearing deposit, so some savings that you can withdraw on demand. You could maybe put some savings away for 3 years, which gives you a higher level of interest. But if you are going to go through there and then withdraw the funds before the 3 years are up, then you may incur a fee, okay, and you may go through there and receive less interest, okay. The other scenario that you've got there is your short-term treasury bills. So that is investing money with the government, okay. So you are financing the government short term. Key bit, however, is that there is no interest upon them. So it's like, well, what's the point in giving money to the government if you don't get any return for it? Well, what you've got there is the amount that you pay to get the bills is a bit less than what their face value is. And at maturity, you will receive the full face value. So there's a little bit of interest incorporated in the treasury bill. It doesn't specifically pay interest, but the return that you get is based upon the amount that you have deposited being less than the amount that you will get back from the government, okay, on the maturity date. Again, key bit there is that they are highly liquid because what you can do there is you can trade them, okay, you can trade them on the market and therefore get your cash back very, very quickly, okay. Probably going to incur a fee, however, in terms of doing the trade on the markets, okay. We've then got a couple of other bits and pieces. I just have an awareness of what they are. First one is a bill of exchange. Okay, it's an IOU. Okay, let's just think about what a bill of exchange is first before we then think about it as, if you like, a method of short-term investment. A bill of exchange is an agreement between a customer and a supplier that stipulates a specific date when the amount will be exchanged. Okay, so you can agree that, say, within 2 months' time, X amount will be paid. It's a legally enforceable document. Okay, the key bit about your bill of exchange, the reason why it then becomes a method of short-term investment, the key bit there is that your bill of exchange is tradable, okay, because that's where you come along. There may be an IOU between company X and company Y. What you can do is you can buy that bill of exchange from the company, and what will happen there is that you invest that money and then you will then collect it off somebody else, okay. So if company X is expecting to receive the cash, you will deposit the cash with company X and then you will expect to receive it from company Y, okay. Again, there is no interest upon it, but again, a little bit like your treasury bills, the interest is implied in the terms of the bill. A bit like debt factoring, but in reverse. I'm essentially being the debt factor, aren't I? And that when I advance the funds to company X, I give them a little bit less than what I expect to receive from company Y. However, the key bit with your bill of exchange is this is an agreement between two companies, isn't it? So it's not an agreement with the bank. It's not an agreement with the government. So the bill of exchange, I would say, is a little bit more risky than your treasury bills or your interest-bearing deposits. Okay. Excellent. A certificate of deposit, something that's very much used in America. The key bit about your certificate of deposit is that it is a fixed term deposit that you make with either a bank or a credit union. And again, it carries a fixed rate of interest. It has minimal risk because the bank or the credit union will insure the amounts that you have gone through there and deposited. So it is very, very, very similar, if you like, to your deposits. Okay, the deposits that you make with a bank. However, these are for fixed terms, 1 month, 3 months, 6 months, however long it may be. As I said, it's more commonly used within the US. Okay, it has minimal risk. So it's a little bit less risky than a bill of exchange, maybe slightly more risky than your short-term treasury bills. Okay, similar risk, if you like, to your interest-bearing deposits. Okay, you've then got your commercial paper. Okay, again, what a commercial paper is, let's think about that first before we think about the investment. Is whereby a company issues commercial paper as a method of financing its working capital. Okay, similar then to a certificate of deposit, it is then tradable, and that's where we come in as the investor. Okay, we can go through there and invest within that commercial paper and make the deposit, and then at a point in time, again, it's a fixed term, usually less than, is it 270 days. The reason why it's less than 270 days is because the commercial paper is traded, and anything less than 270 days means that there are no notification requirements that have to be made about it to the Securities and Exchange Commission in America. Okay, so it makes it a little bit easier to go through there and issue on the markets. There's less documentation, if you like, that is required. Okay, again, key bit is that if you then go through and then buy that transferable commercial paper, it's there that you buy it at a discount, but you will go through there and get a little bit of capital growth upon it. It does have a little bit of a lower rate of interest. The reason why that is because it is unsecured. There is no security on it. Okay, you may expect there to be a higher rate of interest, but it tends to be a lower rate of interest on the debts. And the key bit that you've got there is because it is fixed term, it is a little bit less flexible than the others. Again, there are, if you're looking to use commercial paper, that there do tend to be minimum deposits that you have to go through there and make. Okay, and they can be quite large, stretching into thousands. Again, key bit is that it's an agreement with you and the company. So again, hopefully it's a large company that would issue it that is very credit worthy, that reduces the level of risk. Okay, excellent. What we've then got, just a brief example. Unlikely to be an example like this in the exam. I think in the exam you're going to have to go through and explain what is short-term finance or what is short-term investment, so don't get them confused. And also you may need to go through there and have a description of a short-term method of finance or short-term investment and match up the correct one. Okay, so here all this one wants us to do is to look at the advantages and the disadvantages to the company of each of the investments using calculations where relevant. I'm not worried about the calculations. The calculation just working out, if you like, a rate of interest. Okay, so what have we got? The specifics are at the top. You have surplus funds to invest for a short-term period of 3 months. Okay, so 3 months isn't very long, is it? So you would expect to go through there and get some fairly low returns over that period, and also you would expect for low returns you would have a low level of risk, wouldn't we? Okay, what you've got there are your treasury bills and your bank deposit accounts. Remember, the key bit about your treasury bills is that there is a bit more flexibility to them, isn't there? Because they are tradable. Okay. With your bank deposit, however, there's a little bit less flexibility attached to it, isn't it? Key bit about your bank deposit is that it requires 30 days notice to get that money. And if you get it before the 3 months have expired, then you may not get that 2.5%, might you? You might get a little bit less, or you might have to go through there and pay a fee. Okay. So if we're just going to go through and summarize what we've got, we'll put it there on a separate page of paper. So what we've got is we have there, is it your treasury bills? We have there, is it your bank deposit? And we're just going to list or think about the advantages and disadvantages. Okay. So the advantages of the treasury bills, I remember that is that it's with the government, isn't it? So it's pretty low risk. Okay. Also, as it is with the government, it is tradable. So that there is pretty liquid. Okay. It is liquid because it is tradable on the markets. Okay. The disadvantage, I suppose, is that you get no interest on those treasury bills. It's all built into, isn't it, the amount that you deposit and the amount that you get back. With regards to the bank deposits, I suppose the advantage there is that you do receive interest, don't you? So I think in this instance it was 2.5%. There may be no interest, but on the treasury bill, you do get a return, don't you? Okay, you can have a look and you could work that through, couldn't we? Because what we've got there is we get a return, don't we? Is it of $5 on the $995 that we invest? You could work that out as a percentage, couldn't we? Very low, but then you can annualize that, couldn't we? Okay, for the 4 quarters. What you've also got as well with regards to the bank deposit, it's with a bank, so again it is low risk, although I would caveat that by saying it is ever so slightly higher, okay, than your treasury bills. And the disadvantage of your bank deposit is that you have to have, is it 30-day notice? So 30-day notice means that it is less liquid, isn't it? Okay, there we go. Key bit that you've got if you wanted to equate the returns, you've got there, is it 2.5% per annum? And then if you go through there and work it out based upon your 5 divided by 995, that equals, is it 0.5%, but that there is per quarter, isn't it? Okay, so in order to go through there and work it out on an annual basis, you would need to do 1 plus the 5 over the 995 and raise it to the power of 4. Is that right? 5 divided by 995. 1 plus my answer, the power of 4. And then subtract 1, isn't it? There we go. That gives you there, is it 2.03%. Okay. So what you've got there is 2.03% on the treasury bill versus, is it the 2.5% which was on the bank deposit, which is great, isn't it, if you think about it, because you've got less of a return on the treasury bill because you have that little bit less risk. than what you have on the bank deposit. Okay, there we go. You're unlikely to have to go through and do the calculations that we've got there. I suppose that's just a little bit of showing off. Remember, what you've got there is that this 5/95 was, I think, for 91 days, which essentially is a quarter of the year. So we need to raise it to the power of 4, or technically 365/91 if we wanted to be all specific, to work out the annual interest. Okay, there we go. All I would do is I would ensure that you work through the questions. They're a bit dry, they're a bit dull, there's nothing too exciting about them, but plow through them and ensure that you're happy with what the different types of investments are short term, what the different types of finance are short term, and that you know what each one of them specifically is. Okay. Other than that, I'll see you all in the next session. Hopefully you won't find any of the questions too particularly difficult.